Hey everybody, it's Matt Day with Founders Floor, and this is my mentor moment where I cover topics and answer questions related to startups and entrepreneurship. But first, a quick message from our sponsor.
Procopia Law, the recommended law firm of Founders Floor.
My mentor moment this week is in regards to the mistake founders sometimes make in overcapitalizing their startup and taking away from future options to exit profitably for themselves and early investors. It's important to understand that once you take outside money as an investment, that clock starts ticking on the time frame for a return on that investment. And the more money you raise, the higher the valuation is expected of your company and its future returns to investors. The goal is to raise just the right amount of money at each funding round as your company grows, which can be easier said than done. If you don't raise enough capital, the lack of resources can artificially decrease your growth potential, or worse, you run out of cash as you go through multiple pivots. But raising too much capital too early can be just as bad, as founders can overly dilute themselves while significantly increasing their burn rate to reach new, higher growth metrics needed to achieve lofty valuations now expected by their VC investors. That's what's called the go big or go home growth funding mentality. Now, if everything goes as planned, then that works out. But if things don't go as planned, then you could be faced with having to raise more money in a not so friendly deal terms where founders are diluted even more. Or worse, raising a down round where your large VC decides not to follow on, but instead reallocates capital to other portfolio companies they have, which are pacing to be billion-dollar companies for them. In this scenario, even though this company might never be a billion-dollar company, the sad but common reality is that if this company would have raised less money earlier on, they could possibly have grown to be valued at a $50 or $100 million company, with the options to potentially sell and exit profitably for the founders and early investors. That's why it's important to match the stage of funding that your company is raising with the VC firms that have the appropriate funding stage focus. For example, the economics of a VC firm with a $400 million fund is such that they have to allocate more capital to each portfolio company, and each company needs to have a growth trajectory to be a billion-dollar company for that fund's economics to work out to get the returns they promised to their LPs. So fund focus can help determine their funding stage and allocation of capital needs. That's why we recommend our startups to raise funding based on what their expected growth needs are. Then, as the company progresses, they can reevaluate the company's growth potential and raise the next round accordingly. Maybe your company can be a billion-dollar company. Maybe it'll be a $50 or $100 million company. In either case, raising the right amount of money at each funding round will give you options, including more lucrative exit potential for you as founders, your employees, and early investors. If you like this commentary, please subscribe, follow, like, and retweet us on social media. I'll see you next week.